Hi, good morning. Following on from the session we did previously, the last thing I should have a look at were what financial assets and liabilities were and do a little bit of research on that and find some examples. So today we're going to have a greater look at these two sections of economics. Now I'd like to do is just pause for 1 minute and just remind yourself of what financial assets and liabilities were from the work you did last lesson. So in a second I'm going to ask you to pause and pause for 1 minute. Okay, pause. Okay, so hopefully you've looked back at your work or you've reminded yourself from a previous lesson of what we're actually looking at. Now, financial assets and liabilities. So assets are basically anything which is worth something. Liabilities is something which is costing the business something. So a liability is something which will essentially drag you backwards, whereas an asset will move you forwards. So on this slide here, I've got a lot of examples of lots of different issues of what they are. So I'm just going to ask you again to pause it in one minute. Take a couple of minutes just to read through that. And then what I would like to do is anything you're not sure or any keywords you don't understand, I'd like to look it up online and make a note of what those keywords mean. For example, what derivatives mean. And I'd like you to spend a few minutes doing that. So pause. Okay, so hopefully you've had a look at all these different assets and liabilities, what they are. Hopefully you've also had a look back at some of the issues that you might not really understand. What we're going to do in today's session is we're going to do two different activities which links this idea of assets and liabilities. First is I'd like to have a lock at this case study which looks at something called equity, which is essentially value. What I'd like to do is I've attached with this a copy of the document you'll need, which is this one here. Nope, this one here. You'll be able to print a copy of this off, and I'd like you to have a go at answering these two questions. So once you've read the article, I'd like you to have a look at these two questions. So first of all, what is the negative equity trap? Now, if you don't understand it from the case study, then once again, take it on yourself and do a little bit of research to find yourself a definition of it and then a way of understanding it better. Second question, in the years after 2007, young house buyers who got into a property ladder just before the financial crisis were the main victims of a negative equity problem. Explain why this was so. Now, you should have a good idea what the negative equity trap is, because we have discussed this in relation to the housing market and the purchase of my own property about 10 years ago. So you should be able to use that as an example. But what I really want to focus on this is this section here. Explain why they were the main victims. So everybody was essentially affected by the negative equity trap, but why specifically was it young house buyers? Now, I'd like to spend about 15 minutes on this. So in a second, I'm going to ask you to pause again. Give yourself 15 minutes and then come back to the slideshow. Okay? You can pause it now. Okay, welcome back. Let's go back to having a look at the next tab. So hopefully you've had a look at these activities. We'll go through them when I return back in a day or two. But the idea every time, obviously, the negative equity trap is when you purchase a property, for example, in this case, and the value of it drops. So you end up owing more money than you actually your asset is worth. So in the case of a property, for instance, you might purchase a property for £200,000. Maybe you take a mortgage for that value. So you borrow £200,000 against a property which is worth £220,000. If the market slumps and then the property drops to only being worth £190,000, you're then left with a £200,000 debt and only an asset which is only worth £190,000. So if you were to sell your asset, the house in this case, you would actually still have a shortfall. You would sell your property and still owe the bank £10,000. Now, the reason young buyers got into this problem was essentially because of the percentage they borrowed. So basically, during 2007, it was a lot easier to get mortgages, but banks were offering high percentage mortgages. So you were only needing to find a 5% deposit. So if you're buying a £100,000 property, you were able to take a loan for £95,000 and only put a £5,000 deposit on it. The problem was most properties lost about 15 to 25% value during the housing market crash during 2008. So that £100,000 property was suddenly worth £75,000 and you still had £95,000 of debt. So you had negative equity of £20,000. So basically it led to a high level of lack of confidence in the economy and spending dropped to a huge proportion on consumer goods, therefore slowing down economic growth and essentially seeing all those negative impacts we talked about last year. Okay, the second task I'd like to have a look at is a much wider, much larger issue. Basically one of the first trigger moments for the banking collapse of 2008. So we're going to have a look at Northern Rock. We're a high street bank who were quite large in the UK, but they were one of the first banks to collapse, which basically set up the whole banking crisis we know about. I've attached a Guardian article, which I'd like you to have a look at. It's a worksheet, it's A3, so you will need to print it probably in the library rather than in a professional studies building. It's quite a big article, looked at why Northern Rock was doomed to fail. So if you have a read through this, there's quite a lot of information. You may need to highlight or at least certainly proofread 2 or 3 times the information. Then I've added a load of tasks for you. So the first thing I'd like to do is, using the article, identify the assets and liabilities of Northern Rock. So find out what they were, why were they liabilities, what are they, why are they assets. So don't just bullet point an asset, you have to explain what the asset actually is and why it's of a value to the business or why it's a liability to the business. Your follow-up task to that is, I would like essentially an evaluation task. I want you to decide what, in your view, what the major mistake was. What was the biggest problem? Now, what you can do in this section is you could identify a series of problems, a series of mistakes the bank made, almost in a mini analysis task, and then include what you think your final major mistake was for Northern Rock. So essentially you're choosing your evaluative point, so saying which point caused the biggest problem, and then say why that was a bigger problem to everything else. And this last task, to what extent should a portfolio be balanced? What I'd like to do is have a look online at what we mean by a balanced financial portfolio, and I'd like you to use your little bit of research to answer that question in as much detail as you actually can, in order to give you as much information as you possibly are able to use. Now, this will be a good practice for future exams. Also, it's going to give you a good understanding of assets and liabilities and the problems associated with them. This final task should probably take you a good 45 minutes or so. Please keep a copy of this. We will review it in the next lesson. Okay, thanks. See you soon. Bye.